Look, we're in a bull market. It's been clear. Asset prices are high. Credit spreads are low. Consumer's still okay. The consumer has jobs. Remember, the jobs is what usually starts to force people to cut back and change things. And consumers spend less and companies cut back. So far, so good.
The CEO of the world's largest bank just dropped a warning that nobody saw coming. Jamie Dimon, the man who manages $4 trillion in assets, says a recession could hit the United States in 2026. And no, he's not joking. While everyone's celebrating 4% GDP growth, he's seeing something others aren't. Stay with me, because what I'm about to reveal could completely change how you manage your money over the next 12 months. Welcome to Asset Archive. I'm David, and I'm here to give you the financial information that truly matters, no filters, no agenda. Today we're talking about something extremely important. Jamie Dimon, CEO of JP Morgan Chase, has just issued a red alert about the American economy. In this video, we'll cover why Dimon predicts a possible recession in 2026, the 3 hidden factors undermining the economy, what you can do to protect your investments. And before we start, if you want weekly content on economics, markets, and investment strategies, subscribe to Asset Archive and hit that notification bell. That said, let's dive right in. Let's start with the facts. In October 2025, Jamie Dimon sat down with Bloomberg Television and made it clear he believes a recession could happen in 2026. But what struck everyone wasn't just the prediction itself, it was his approach. He said he's hoping for the best, but planning for the worst. This isn't someone being pessimistic for the sake of it. This is someone preparing for reality. And this wasn't the first warning. Back in September, after revised labor market data showed the economy had created fewer jobs than previously thought, Dimon told CNBC that the economy was weakening. He didn't know if it was heading straight into recession or just slowing down, but the direction was clear. So let's recap. While US GDP is growing at 4%, while stock markets are hitting new highs, while analysts are talking about a soft landing, Jamie Dimon sees something completely different. And now I'll explain what. Why is Dimon so concerned? There are 3 ticking time bombs ready to explode. The US national debt is now a structural threat. We're not just talking about big numbers, we're talking about numbers that can destabilize the bond market and increase financing costs for years to come. Dimon sees this as a growing problem that could strain interest rates, making it more expensive to borrow money for businesses and households. And when credit costs more, the economy slows down. It's mathematics. Second point, inflation hasn't disappeared. Sure, it's down from 2022 peaks, but it remains sticky, persistent. And Dimon notices something concerning. American consumers are holding up only thanks to pandemic-era savings and credit usage. But what happens when these buffers run out? Households reduce spending, companies sell less, profits collapse, and layoffs begin. And in fact, recent data shows warning signs. Manufacturing growth is slowing, default rates are rising, and wage gains are flattening. These are early indicators that the consumer engine driving 70% of the US economy might be running out of fuel. Third factor, the world is on fire. Global conflicts, trade disputes, tariffs. Dimon emphasizes that these external factors can dramatically complicate the economic landscape. When supply chains get disrupted, costs increase. When countries fight, investments retreat, global trade slows, and the United States, as large as it is not immune to these global pressures. But wait, there's another piece of the puzzle. In September 2025, the Consumer Confidence Index fell for the second consecutive month, dropping 3.6 points to 94.2. But the most disturbing data? The Present Situation Index crashed by 7 points to 125.4, marking the steepest monthly decline in a year, and the Expectations Index dropped to 73.4. Why does this matter? Because historically, when this index falls below 80, it signals recession risk. And we're getting dangerously close. And that's not all. The share of consumers who believe a recession is very likely in the next 12 months rose to the highest level since May. Even more striking, a growing number of consumers think the economy is already in a recession. This is a huge problem because 70% of the American economy is based on consumer spending. If people are scared, they stop spending. And when they stop spending, the economy collapses. It's a self-fulfilling prophecy. Now, the question is all this inevitable? Dimon himself says no. He recognizes there are positive factors: innovation, infrastructure investment, deregulation, and the fiscal stimulus from recent government policies. These could provide real support to the economy. But here's the critical point. These positive factors may not be enough if policymakers don't act proactively. Dimon is calling on the government not to be complacent. He believes the U.S. can't rely solely on interest rate cuts from the Federal Reserve. What's needed are balanced fiscal policies, strategic investments, and smart debt management. In other words, there's still time to avoid disaster, but the window is closing. And for you as an investor or saver, here's what you need to do. 1. Increase liquidity. In uncertain times, cash is king. 2. Diversify investments. Don't put all your eggs in one basket. 3. Reduce debt exposure. If you have variable rate loans, consider locking in rates now. Invest in defensive assets. Sectors like utilities, healthcare, and consumer staples tend to hold up better in recessions. So, what do you think? Do you believe Dimon is right? Or do you think he's just being overly cautious? Write it in the comments below. I want to know your opinion. And if this video was useful to you, leave a like and subscribe to Asset Archive so you don't miss the next updates on economy and finance. Let's hit that notification bell together. Here's my final prediction. Dimon is not someone who cries wolf without reason. He's been through the 2008 financial crisis, he's seen Lehman Brothers collapse, he's navigated through storms that sank century-old banks. When a man with his experience issues a warning, it would be foolish to ignore it. 2026 could be a pivotal year. The question isn't if there will be challenges, but how you're preparing for them. I'll see you in the next video. And remember, invest with your head, not with your emotions. This is David, and this is Asset Archive.